So maybe I shouldn't have done that, right? I think I just hit start broadcast.
Now we're live to our waiting public. So hi everybody. Everybody gets to see. It's all good. Let's see. So I can still see your screen. It's odd though because I just can't see. Let me play around with this webcam
Here,
thing.
let me get in and out again, okay? And then I'll attend again and see if it makes a difference.
Okay, perfect.
Thank you.
Okay.
About seeing a new presenter and worried if you're going to be falling asleep. And I promise that this whole presentation is geared towards helping you sell more homes and more real estate and understanding the tax code and the reform, not just from a technical point of view, but what are your potential clients thinking? How can you use this to gain confidence to sell more in the market today? But we'll go over all of that. I'm going to share my screen for a second. That's okay, Eric?
Absolutely. Yep.
All right. So I want to just say that I'm Chris Whalen, CPA, and I have a very realtor-friendly office here. We have great staff, and we do a lot of work with realtors. And I've been licensed, got my CPA license really in 1990. We are business and individual tax experts. And of course, for all my real estate agents, I always tell them to make sure their clients know there's a free consultation with me. If you have any questions or concerns, even during your day on the fly, you're sitting with a client, they might have a tax question. Well, it's always a good time to call me. If you look at the bottom of the screen, maybe just make a simple note of my contact. That's my cell phone number. I give that out really to real estate agents so they can get me when they really need me. And just in brief here, again, we specialize in real estate brokers and agents, and we do a lot of investment property strategies, tax benefit analysis, a lot of commercial transactions, 1031. So anything and everything with regard to real estate. And all of the normal things that a CPA would do. And at the bottom of your screen, you'll see my motto. If we aren't working for you, then you aren't working at your best. You're almost there. You're close. But like I say, it's always good to have a CPA in your corner. So
Absolutely.
Erica,
And what we had talked about, Chris, offline was even though you're in New Jersey, as we always do for All Access, this is really going to cover more of the broad-based federal things, but you accept clients out of state as well. So this isn't just a New Jersey promotion. If you like what you hear today, feel free to contact Chris because he'll work with pretty much anybody.
right, everybody does a federal tax return, and we can handle every state in the union that has income taxes. And so I urge everyone, again, even here, we're doing live hangouts or Skype with clients and real estate agents all over the country all day long. So it's easy to get me on a video conference with yourself or with a client any day. We have a full facility in my office to broadcast wherever. So,
Love it.
um, so do you want me? So can I get
Yeah, let's
started?
look at the slides. You got all this great stuff to cover, so why don't you take it away?
Okay.
I'm gonna go off the camera. I think people are they don't need to see me kind of staring at them. I don't know if you want to do the same, but I'm gonna kind of duck out of here and let them focus on your slide deck here.
Right. So now everyone should just see my main slide here, which is selling real estate after Trump tax reform. Does that look good, Eric?
Yep, looks great. You're good.
All right, great. So that's really the crux of this today is so now we have a new market, we have a new paradigm out there, and what can we do to make sure we understand enough that we can beat the street? That don't forget that if we look out the window, there's the market is out there and everyone has to deal with it. So the more educated we are, the more that we're going to be confident, the more that we're going to be able to sell above any other broker on the street or agent. All right, so I got a couple of pre-questions, I call them. Thank you for writing in. A bunch of people wrote in, and Doug J especially wrote a bunch of things in here. So what I'm going to do is try to address his questions, especially what I think are very pertinent ones, because everyone might have these. I've even augmented even up to the last. He just emailed me 10 minutes ago again, and I've included a few other things. So this might go a little longer than expected, but I think it's good information. So
Yeah,
he said,
and just to that point, yeah, don't feel constrained by the time frames, Chris. Again, this has been a often demanded topic, and I know that not everybody can make the 11 o'clock time slot, and if they have to hop off at 11:30, it's understood. We always record these, so feel free to answer take as much time as you feel you need.
Okay, Doug wrote a great question initially. I look forward to attending. There are many rumors going around regarding how bad the new tax code is for people living in New Jersey and a few other high tax states. And that's exactly what this seminar is for. And we're going to get into the meat of this. Eventually, you're going to see that I address those fears, and they're very unfounded fears, if I could say.
Hmm.
So his first thing was, what are the differences in the standard deduction and filing an itemized return? Well, just to back up a little bit so everyone understands, the IRS allows you to have a standard deduction, or you can itemize your deductions, take real estate taxes, mortgage interest, charity. And so if your itemized deductions are higher than your standard, you take the standard. So just for Doug's edification, I put in here what are the different rates for the different years. So we'll see we have a larger standard deduction, which is good, especially for people that don't itemize. Look at the married filing joint, it almost doubled. But you have to remember that personal exemptions are eliminated. So that was about $4,000 a person.
Hmm.
So although Trump gave something, he also took something away. So it is a good change, but there are some takebacks here. But overall, it's better for everybody. So I hope that answers Doug's initial question.
That's great. Appreciate that.
Next thing, please include business deductions in the answer for question 1. The only change to business deductions is the elimination of entertainment. Now, this has been a problem because there's a lot of misinformation out there. Meals are not entertainment. It's separate. Entertainment are box seats to a Yankee game, hotels down in Las Vegas, things like that. That's entertainment. Tickets for a show on Broadway. So your meals that you want to have with a potential client are still deductible. Money that you spend for food for open houses and things like that are fully still deductible. So don't discount those, but entertainment's not. And I like to make the distinction because a lot of people think, because if you look at it, it says on the tax return, usually meals and entertainment, everyone thinks that it's one thing and it's not. Okay. Number 3, what are any surprises in this year's itemized returns that we may not know about? Well, those are the SALT deductions that we're all worried about, and they're covered within this presentation. Okay. Now, the last thing that he mentioned to me was just about a few minutes ago was, what about buying or leasing a car? How do these expenses work? And it's a very important conversation. This is actually part of a secondary accounting related presentation that I do for agents, but I brought this in now because he had a question.
Right.
So we have, first question is, it's usually, do I take mileage versus actual expenses, which means, am I going to keep track of my gas, my maintenance, my registration, my insurance, or am I going to take a mileage rate instead of those things? And the most important thing here is that when you put a car in service, you have to choose which method you're going to use. You can't switch in a few years just because your maintenance gets higher. Big mistake I see. So that's first of all. And whether you lease a car or buy a car, you still have to keep track of your mileage for business purposes. Remember that. It doesn't matter whether you buy or own. Your percentage of business use for either method is going to come from your mileage. And that's a very, very important thing. And mistakes are made with mileage. So you see that here. I went over here. Mileage logs are required for both. And remember, the bottom line here, tolls and parking is not part of your auto expense. Even if you do mileage, that's a separate expense that you can take. And sometimes people, when they do the mileage method, they think it encompasses tolls and parking, but it's not. So remember that. Keep track of your tolls and parking, no matter what type of method you use, okay? All right. So the mileage rate in 2018 is 54.5 cents. Mileage rate in 2019 is 54.5 cents. This goes up and down depending on what your average gasoline prices are, and the IRS adjusts it every year or leaves it the same depending on that, on how much that delta is, how much the change is in average. So it stayed the same because gas prices have stayed relatively the same average year over year. Mileage logs, very important. Real estate agents, everybody listen. Everyone, they don't like to keep logs. They do estimates. Remember, when the IRS comes to ask you a question, 99% of the time, the first thing they're going to ask you is something about your largest expense. That's usually your auto and your mileage. So if you don't have the right logs and information, they will throw out that expense and charge you tax on it. So I can't enforce this or reinforce this thought enough. So under audit, again, the mileage deduction can be denied. All right. So what are the basic rules? Well, no estimates are allowed. We need exact mileage. So they would like each trip itemized with the business reason listed and then the mileage totaled annually. Now, I know this seems onerous, but I give you some hints and tips to sort of get around it to still comply. Now, if you look at your screen, I put this up. This is what the IRS sent me. Years ago, I wrote to them and said, send me exactly what you require. Now, look what they want. They want each trip itemized with the start and stop odometer reading, expenses along the way. Now, that's not possible, and no one's going to do this. But I wanted to show you what they ask for, and this proves they're not business people. They're just bureaucrats, right? All right. So we have, so what can you do to comply? Okay, there are mileage apps out there that they're helpful, but they're limited. What I suggest is this. Everyone has a calendar, and everyone is putting down their events of the day and where they're going. I would love you to have in that calendar the exact address of where you're going for appointments. Most have that, plus who you're seeing. So it could be 2 Oak Street, Chris Whalen. That's fantastic, because then if I can download that calendar eventually under audit, I can rebuild your mileage, right? If you started in Oklahoma City and went to 4 different towns during the day and then came back home, I can rebuild that mileage, can't I? Because everyone starting from home is a home base usually. Most real estate agents are really home based, even though they have an office to go to. Then we want to print out the monthly reports and save them somewhere. Remember, estimates don't cut it. So this is a good way to use your calendar, that we can use that to comply eventually. I hope everyone sees that.
Excellent.
So what else can you do? Now, Happy New Year, I say, because at the mileage method or the actual expense method, remember, starts with mileage. Now, the mileage number you need most of all is total mileage. So what do? So the beginning of every year, the first of the year, everyone should wake up and take a picture of your odometer, because that's going to give me year over year exactly how much mileage I drove, which is 90% of the battle with the IRS. No one has that. Yes, you can go to Jiffy Lube or your oil place and see what the mile, but that doesn't work. This is what I want you to do, is put a little reminder January 1 of next year and take a picture of your odometer so we can start this process. That's a good way to comply. If you go to the IRS and say I have 24,200 miles on my Camry, and I can prove it to you with date-stamped pictures, believe me, that's a great place to start for them to show compliance. So it's a little trick I use, and all my clients do this now, and they're very happy about it. Okay?
Good Great. Stuff. So, Chris, just before you move on to the meat and potatoes of the next component of it, I just wanted to address Giselle's question, because while it was on the topic, and I know a lot of realtors that do this, if I have a party at my home, if I have a party at home for my clients and colleagues, should I report it as a meal, or is that a promotional event?
No, it's definitely promotion, right? So a meal is something very specific that you're out and you are meeting one-on-one with a person or two. But if I'm entertaining, like for example, when I go do a presentation, if this was in person with you, I might supply food, I might supply lunch, and that is not a meal. That's a promotional expense.
Got it. Good.
Okay,
thanks for that question very much, Giselle. Appreciate it.
Yeah. All right, so now we're on to the next important question. I wasn't asked this, but this is where I'm going to get to this. Are realtors eligible for the new 20% qualified income business deduction? Absolutely. That's very important. This was made for people like you. And what I'm going to do now is just take you through some quick spreadsheets, some examples, some rough numbers to give you an idea of what kind of savings you might be looking forward to from between 2018 and 2017. So we have this person. It could be you. You're single with no children. I did that to make it simple. And we have Schedule C net income of $100,000. So you're a realtor. That's your net income. That's after expenses. You're showing that profit. So it's plain and simple to get to your taxable income number. We take 20% off of that, and also we get that standard deduction we spoke of earlier, $12,000. So that means our taxable income is $68,000. Very simple to understand. And the income tax on that is exactly $10,899. Now, as self-employed people, our taxes don't stop there. Remember, we have to pay self-employment tax, which is really our FICA. as opposed to having it on a W-2. So that self-employment tax is 15.3% on top of against your total income of 100,000. And don't forget that the qualified business income deduction does not apply to the self-employment tax portion. So you see that self-employment tax is $15,300, right? So it's not 15.3% on 100 minus 20. Very important. Don't make that mistake. So our total taxes are income tax of $10,899 plus self-employment tax of $15,300 gives us $26,199. So that would be your total tax bill for 2018. Hopefully you paid some estimated taxes in. Okay. So now let's take a look at, let's compare that though. Let's go back now, back to the past, and let's look at 2017, where we would have been with the same exact fact pattern. As I said at the beginning, a lot of the media, they don't do things like this. Well, how is a single person with this income going to fare? So let's take a look. So we have $100,000, same income. We did not have a qualified business deduction in 2017, but we did have standard deductions and exemptions of $10,400. So our taxable income is $89,600 in 2017. Now the income tax on that is $18,139. Now let's quickly compare that to 2018. Look at the difference. The 2018 tax is much less. So this is a real impact of the Trump tax reform. That is, there were a lot of complaints in the media that Trump was giving corporations big tax breaks. And yes, they got tax breaks because we were well behind the world in terms of taxation on corporations. So what he wanted to do is bring that same level of savings down to small business owners, which is very fair. So now let's keep going down our spreadsheet. Remember, self-employment tax should be the same because we can't get a qualified business deduction. That's still $15,300. So our total taxes now are $33,439 in 2017. In 2018, now we've saved $7,240, or about 21%.
Yeah, that's really nice. That's a great illustration, Chris. I'm really glad you provided this in such granular detail. I mean, that's a real nice savings.
Now don't forget that there are limits. So a single person, if they net over about 160,000, you start to lose this benefit a little bit. If you're married, if you go over $260,000, or a little over $350,000 rather. So there are limits the more income that you make, but a lot of people don't make over $150,000 net.
Yep.
So this is a really good example that even if you made $50,000 or $150,000, relatively speaking, you're going to be in the same ratio of savings. You understand that? So anyone could look and say, wow, this person saved 21%. And again, so we can back in to see if this proves, right? It's basically a 20% reduction on taxable income. And if your FICA or your self-employment tax is static at 15.3, then me coming up with a 21% savings makes perfect sense. Okay?
Excellent. Great illustration. Already getting great feedback. Debbie's loving it so far. Thanks, Debbie.
All right. Oh, good. I'm glad Debbie's happy. Now, this is a very important slide. I want everyone who might be triggered by the president to take a step back. It doesn't matter what you think of the president. Some of you think of him like this, and some of you think of him like this. It doesn't matter. So this is all about at the street level. How are things impacting us? So it is Trump's tax reform, but it is helping people. So let's go forward. And you have no idea how many people get upset if I even say that it's Trump's tax reform. I'm sorry. I don't want to trigger anybody. Of course, I'm being facetious, but let's go on.
Right. But we are a political free zone here, so it's all good.
Exactly. So let's talk about what's been in the news. And this goes to Doug's questions. And this is actually a headline in Moody's, from Moody's, the news service. President Trump's tax plan will soon hit homeowners hard in ways they have not expected. All right. And this is what they say, which is what everyone's afraid of. The tax reform plan will leave many taxpayers with less disposable income and wealth and less money for a house. That problem will ultimately cause housing prices to drop. That is the crux of this media hysteria. But I tell everyone it's fake news, 100% fake news, because, as I said before, you will never see an article or hear someone on television that is giving you analysis like I just gave you. See my spreadsheets I just gave you? It's not hard to do. I don't guess here. We have the law. Let's apply it. So when someone doesn't give me analysis on something that the facts or rules are in place, it makes me question them. So this is the important point. Our jobs as professionals is to educate, right? That's our job here. If we do that, our sales will increase. That's that simple. So as I said before, what's out there on the streets, out there on the street, every agent and realtor has to deal with it. We just have to be more prepared and more confident, and we're going to outsell everybody. So in the market, we now have buyer paralysis. That's what I call it. It's a very, very bad condition. What are the symptoms? Well, there's a fear that the tax changes are going to reduce home values. Very simple. And realtors are not sure how to answer. That's a very bad combination, right? Someone comes into your office and says, I'm not sure if I should buy this house because I'm going to have a limitation on my real estate tax deduction. Could that be okay? And most realtors have to say, I don't know. And that's right. We don't want that. But I have the cure. A CPA can cure this with analysis. That's what's great. So I can get them over this paralysis, and then you can sell your homes for all the great reasons you do. You know, cul-de-sacs, granite countertops, stainless steel appliances, all the good reasons, right? So
they'll
here,
be flying. Yep.
Go ahead. I'm listening.
I said they'll be flying those houses, right?
Exactly. So you're not tax experts when you get questions, but how should you handle this, right? Think about it. What do you do? Like me, let's say someone came to my office and said, Chris, I need you to go over the details of listing a house. Now, if I were to try to do that, you would say, Chris, that's overstepping, right? And you're 100% right. So this is a very important slide. A seasoned CPA can help you analyze the impact for you, Mr. or Miss Client. If you don't have one, please let me refer one named Chris Whalen. Most important slide of the day.
We'll keep that one up first.
No, really, this is the most important slide of the day. These next two. Now, this is wording that you can say to someone. Imagine someone's coming into your office and they're nervous about this. This is something you can say, which is true, which you'll see when I'm done. That imagine you said this to a customer. I work closely with a CPA, analyzing scenarios. We found very few where there was a negative tax consequence. So that would instantly make someone think that you're confident and conversant with things, and you're pacifying them at the same time, but you're not overstepping, right? So this is a really good thing to have, and confidently say it, and you'll see why when I'm done. But this is the key. Everyone to remember this, especially with the spring coming, that many families will have more after-tax income. Even if they have a limitation on deductions, you'll see with the law, all the parts of the law, people are faring better. And so you should be selling higher priced homes more often, as opposed to this fear, oh my God, are we going to have some problems with house values or pricing? It's the opposite. This is my prediction. I've done this for a long time. In the spring, especially, you're going to see even more of a seller's market. So prices should go up. People will have, right, if people have more after-tax income, their debt-to-income ratios are getting better, which means what? We get a better mortgage. All right, so is that okay, Eric?
Absolutely, yeah.
All right, good.
Fair.
So
it's very much fact, and that's how the market plays. You know, people feel confident. People feel like there's more money in their pocket. Once they get clarity about these impacts, yeah, they're going to feel more comfortable to spend for sure.
Exactly. So I want to touch on 1031 exchanges because I get this question a lot, and it's only one slide. And remember, a 1031 exchange, for people that don't know a lot about it, it simply will say if I have an investment property that I'm selling and there's a gain in there, let's say I have a gain, a capital gain, and I would like to not pay that gain, I can roll that gain into another property. I can exchange it. But the most important question to ask, all of my agents listening right now, if you have someone selling an investment property, this is the question. If you don't need the proceeds from the sale, consider a 1031. Remember, if I take the money from the sale of a property I have a gain on, if I physically take it, I cannot do an exchange. It has to be done in a special way with special exchange agents. So remember that. But ask this question, because and then of course you call me and we talk about, well, what can we do with that? Anyone planning to sell? Believe me. A lot of them don't know about this, and imagine they don't need $1 million from the sale and they have a $400,000 gain that's sitting there. If we buy something of equal or greater value, we can push that $400,000 gain and tax down the road. Okay? All right. Itemized deductions. What has happened to them? This is like a horror story, right? It's a horror movie. All right, so let's talk about some specifics that impact your clients. Okay, mortgage interest on primary and secondary residences. Now, in 2017, the interest that was on loans up to $1 million in principal was fully deductible. So, if I had a principal of a mortgage that was $2 million, and I got a $20,000 mortgage interest 1098 form, I could only take $10,000. I only take the prorated portion. So now, after 2017, that principal value goes down to $750 for new loans that were closed in 2018. Meaning, if I have $1 million mortgage and I get $10,000 in mortgage interest, that means that I only can take $7,500. Now, this doesn't affect a lot of my clients. I know they're high numbers. A lot of you might not be impacted, but it's good to know. And so what's the play here? So let's say someone has $1 million that they want to get in a mortgage, but they say, well, I can't take the full interest deduction. I only want a mortgage for $750. I'm going to put down another $250,000. But with the money being so cheap, we want to counsel them to put that money into another investment property, right? I want that $250,000. They might pay interest of 4 to 4.5%. It can't be deducted, but I want to use that money to invest in real estate investments because, of course, in the long run, we're going to beat that 4%. So that's also something to think about. If you ever get someone on the fence about putting more down because it's not deductible, we as real estate agents, we can find a good use for that additional $250,000. I know I could. Right?
Absolutely.
Right. So mortgage rates have been increasing. So it's another home buyer worry. But as you'll see, tax savings may offset this. Right? If we have customers who have an extra quarter point to pay, and that increases their mortgage on the monthly basis by $65. Well, what if they're saving $200 a month in taxes? So that we have to look at the difference in the tax savings from 2018 to 2017 and say, yes, I have an increase in rates, but a lot of times the tax savings and my after-tax income will dwarf that. So if it goes up a quarter or half a point, they still can afford the same house or better that they would have in 2017. So it's a very important when, again, I'm always looking to answer my customers' worries. And in this case, that's a big one, right? But we can look at the numbers. Looking at the numbers, analyzing the numbers after tax usually puts a smile on people's faces. All right, let's talk about HELOCs, home equity loans here. So after 2017, you have to assume that these are mostly disallowed, even if you had the loan before 2018. They're very specific about it, unless it was used for acquisition indebtedness, and I'll go over that in a second. Right, so the interest used for any other purpose is no longer deductible. So trips to Cancun, money used for college with a HELOC, you cannot take it as a deduction on your taxes any longer. Now, remember, home acquisition indebtedness is not just when you buy the house, it's also if I improve it. So yes, if I get a HELOC or an equity loan to build the deck, to build the kitchen, to put in a pool, do anything that improves my home, that is still defined as acquisition indebtedness, and you can still take it as a full deduction. So assume that it's not deductible until someone tells you specifically what they're going to use it for. All right. All right, mortgage insurance premiums are still deductible in 2018. So another positive selling point for you, right? We have to pay mortgage insurance premiums, if we have less than a certain amount of equity, but at least we can still deduct it. Mm-hmm. All right, child tax credit. This impacts your clients greatly, and this is going to have a great effect this spring. So let me explain. The child tax credit would give, say, a family whose gross income is under $110,000, $1,000 per child for children that are under 17 at the end of the year. Now, that $110,000 was for a couple is very low, and it hasn't been increased in a long time. So fewer and fewer people have been getting a child tax credit. So what the president did is, first thing he said is, wait, for a married couple, that limit should be 400,000, up from 110. So millions of people are going to be getting a child tax credit that didn't get it before. And he also gave us $2,000 per child. So now you might have a couple making 200,000 with a child that's 5 years old. And not only are they going to save money under the tax reform, but imagine they might get a $2,000 credit on top of that they weren't used to. It's more money that they have in the bank on a month, or more money after tax they have to buy a home. So this is a very important thing to look at. People with children, is to see a lot of them did not get a child tax credit in prior years, and now they are eligible. And that's a lot of money to people. It's a lot of money to me. If you get an extra $2,000, is an incredible amount of money at tax time. So very important thing to remember. What is a child tax credit? How is it used? To me, it's more after tax money to buy the home that you want to sell them. All right, now we're going to talk about the impact of eliminating the state and local tax deductions.
That's a big one. People are worried about this one too.
Right, exactly. Those are deductions for state income taxes and real estate taxes. The combination of those two is limited to $10,000. So I live in California. I pay state taxes to them of $12,000. I pay property taxes to my town or county for $10,000, $22,000 total. I can only take 10. All right, that's plain and simple. Now, it sounds like, but there's hysteria in these states. But let's go through some examples, because remember that, yes, in a vacuum, that one change could seem like it could hurt you. But there are other changes that reduce tax rates, that help us, that offset this many times. Okay, just like I said in my slide above, a realtor selling, the realtor selling point, that we have to look at the after-tax income, and that most times people are equal or better in our scenarios that we run. All right, so let's take a look at this. So here is a really good candidate to buy a house. This is a couple that rents. They make $100,000, and they have a family of 4. Now, I set this up with 3 columns because I wanted to do a few things. I wanted to say in 2017, how did they do with taxes renting? In 2018, how did they do renting? And then in 2018, how could they do if they did buy something? So I'm bringing you through this little fact pattern. So let's just take our time. So in 2017, as I said, they have $100,000 of wages. They have no itemized deductions because they're not on a home, and so, but they have a standard deduction of $12,700. And remember, as we said before, if my itemized deductions are higher than my standard, I take that instead. So in this case, though, we have $12,700 of standard deduction. Now we have personal exemptions, which still existed in 2017, about $4,050 per person, or $16,200. So that's pretty simple to understand. With simple math, our taxable income is $71,100, and our income tax on that is $9,736. So let's stop there for a second. It's very simple. It looks like a simple tax return in front of us. That's the tax they would have had on their tax return. Now let's skip to the top of the second column. Same fact pattern, $100,000. Now let's go down to the standard deduction. Oh, look, this is fantastic. Their standard deduction is now $24,000. It's almost double. But as I mentioned before in that slide that we talked about the standard deduction, the exemptions are lost, and that could be negative, and it is negative here. Look, our taxable income in 2018 is almost $5,000 higher than 2017. So, of course, the media would jump on this. Oh my God, this is a disaster. But no, we have to calculate the tax. Let's take a look at the tax number. Our tax in 2018 is almost $1,000 less than 2017. So you say, how could that be? How could we have a higher taxable income? That's because the rates have gone down and the margins have moved. So this is a great example of, say, oh my God, someone has higher taxable income. But what do I keep saying? We have to look at the after-tax income, right? Mm-hmm. Very important. Yep. If you were to look at this couple, they had $100,000 less $9,700 after tax income, but in 2018 they have $100,000, minus $8,739. They have $1,000 more. All right, so let's continue on to the itemized deduction page. So let's say they bought a house, a standard house, and they have normal deductions. State taxes $3,200, property taxes we see $6,800. Let me just see. We're over here right now in this section here. We're up over here, right? So we have 15,000 of mortgage interest and charity of 1,500. Okay, look, we have 26,500 of itemized deductions, and like I said before, that's higher than the $24,000 of standard deduction. So we take that instead of the standard. So now look, we have our taxable income is 73.5, which is lower than 2018, but it's still higher than 2017, right? So
Yeah.
look, but our tax is 84.39. So even with buying a house, having those expenses and itemizing still, we're saving $1,300 over the tax in 2017. Great. So right there, we know we could buy an equal or better house, right, in this situation, no doubt. But let's go back to column one, and now let's go to the bottom a little bit. Now, this couple made under 110,000, which we talked about the child tax credit income limit for a couple, and they had 2 kids under 17, so they got a $2,000 child tax credit. So their net tax was really 77.36. But let's go over to 2018. What did I tell you before? Now those child tax credits are worth double. So they get a $4,000 child tax credit. Their net tax is only $4,739, and our savings is almost $3,000. Go to the last column. It's even greater if we itemize.
Yeah.
So I'm trying to give an example of everyone that's renting that that has a child that you should be looking to them not only because their net tax is going to be lower, right? If they're renting year over year, that's apparent. But if they have a child, look at the difference in tax. Now, this is something important because the media has maligned Trump saying, oh, he's helping the rich all the time. And that's not true. Everyone gets a break in the law. But look at this difference. Look at the difference in tax. It's over 10% of their tax just without the child tax credit. But look, my tax has gone from $9,736 to $4,730 from $7,736, sorry, to $4,739. I've almost taken 40% of a tax break, which is incredibly significant. But you'll never hear the media talk about this. So now, I'm going to leave this slide in a second, but this is a really good slide. And of course, I can provide these slides to everybody. A lot of real estate agents keep these in their desk to reference them because as a good example. But this should show you this is a great target. They are a great target to sell a house to still, and even better than even people that own a current house. Eric, is that okay? Can I move on?
Oh, absolutely. Yeah. And folks, you know that these sessions are recorded and archived on the All Access page. So I appreciate your offer with the slides, and also the your explanations will be able to be given context if you visit the All Access recording page. So it's awesome. It's great stuff. Look, okay. I love math. I wish I was better at it. So this helps me, kind of understand this a lot better because you're breaking it down line by line, which is, what a lot of people like myself, frankly, need to understand a lot of this. So much appreciated.
My entire goal here is that when a client asks you, of course, we don't know their specific situation, but to give you the confidence that you've seen real examples with real data of situations that are going to be in front of you or close to them, where you could say, I've seen a lot of examples and a lot of people fare better. So let's take a look at it, right? That's just to have that confidence and have it be real confidence to give to a client and shake their hand. And it really helps to bridge that gap and make them rely on you even more, which is what we want.
Awesome.
All right, good. Next example is we have a couple, they already own a house and they're married with $230,000. Now I try to find an example where there was a negative. And this is one I found, but overall it's good. So this couple has itemized deductions already. We can take a look at that, right? We have $9,000 of state taxes, $9,200 of property taxes, mortgage interest, charity. Our total itemized deductions are $33,200. Remember, in 2017, we still get exemptions of $16,002, which were for 4 people. Taxable income, $180,600. And our tax is $37,453. Very simple example. Okay, so now let's go to the top of the next page, the top of the next column, rather. Same income, but look at these numbers here. We went from $18,200 down to a limit of 10. This is the salt. This is the hysteria. This is it. I hope everyone's okay and sitting down. So we have for $10,000 limit there. That's important to note. Now we still get our mortgage interest without limit, our charity without limit. So look, our itemized deductions are $8,200 less. I went from 33,200 to 25,000. Now also look, I've lost my personal exemptions. So my taxable income is $25,000 higher than it was. Now,
Right.
just if I were to ask you, this is a disaster. But no, because our taxes are only $325 more. That's how significant the other changes in the code, and everyone can see now how dishonest the media is. We have to look at the full tax code, the changes in the rates and the margins. And look, so we have $25,000 more of income, and we almost broke even with our taxes. So even this couple, you could say, for less than $30 a month, I could put them in the same house. Instead of looking at the intrinsic value of that property tax deduction, we need to look at our after-tax income. There's a perfect example. But wait a second. Look at column 1 at the bottom. They made too much money in 2017 to get a child tax credit. But in 2018, because they're under 400,000 and they have 2 kids under 17, they get a $4,000 child tax credit. So their net tax is only $33,778. They've actually saved $3,600. So we see having children now, everyone can see, wait a second, having these children and your income level is important. And what is the real after tax with the credit? So this is a great example of the tax showed a negative, but now we have these additional credits to help families and people that want to buy houses. It's exactly what this is for.
So in a lot of ways, what you're saying is this could be seen as one of the worst case scenarios. Yet, in this scenario, breaking it down, this could still be a positive for this family, of course.
Right. Let's say we have someone whose income taxes are increased by $1,500. Let's say that negative 325 was minus 1,500, but they had one child. They're still going to be ahead $500.
Yeah.
Right? Because so again, and that's why it's good, honestly, to have a seasoned person. This is not really a commercial here, but you need to have someone at the ready, just like you have a home inspector, right? Just like you have other mortgage people. You need to have someone like me at the ready you can depend on, who can interface with your clients to further pacify them with real information based on my skill set, so we can get them past this worry and have you sell the house that they want. Right?
And then you got some heavy hitting examples, right?
Right. So these are very, I just put this on here. Some of us deal with some high net worth people. So here's $500,000 couple, and they have 2 children, but quickly take a look down at the bottom. They don't have any exemptions in 2017 because they're phased out. Their taxable income is $425,000. Now look to the right. They lost $35,000 of itemized deductions, but their tax is still lower. Their taxable income is $460,000, and their tax is still lower. So even I wanted to show this example because it really shows how the other parts of the tax code have tried to make up for the limitation on the SALT deductions. So this is a really good example that, hey, I gave you everything here. I pushed this. It's hard to even find this kind of example, but I did just to run the numbers to show a really conservative approach. And let's go to the next one. So the next one is $1 million. Look at this couple. They lost $105,000 of itemized deductions. Look at that. Their state taxes and property taxes went from 75 plus 40 down to 10,000. And still we have a tax savings down here. So I'm just trying to reinforce it that it is not a death knell. You should have the confidence to know, hey, there's most examples we're going to break even or do better. And if you can sell that with a smile, people, your real estate client, your real estate competition down the street who haven't met with me do not have the same level of confidence.
Yeah. And look, and that's a fair example. I don't think, I think most of us on this webinar are still not going to leave, feeling like we're tax experts, of course, but we do need that confidence to talk about, how, the changes are not necessarily, as doom and gloom as they may think, and that there is an opportunity to get in on this market, which, to your point, it's obviously going to be varied in different markets in our footprint, but it's a hot market and it's an interesting market. It might be leveling out a little bit more than last year, but it's still going to be hot, and it's starting soon. So this is the dialogue, this is the confidence that folks need for having at least these initial conversations with people about, any concerns they do have about, some of the tax code changes.
Exactly. So I want to mention investment properties here because we just went through all of these examples with all of these limitations. There are no limits on rental properties, okay? So there are no limits on property taxes or other taxes paid with an investment property. You can pay more than $10,000 and you can take them fully on either like your Schedule E, right? We have a rental property, or let's say you have a partnership with someone flowing through from a 1065. So a lot of agents don't know it, and the public thinks that they're limited, but they're not, okay?
Got it.
Now, can I stop? Does anyone have any questions? All right, great. So I want to talk about cloud storage a little bit, and a lot of tax preparers are putting your information in the cloud. And I often say, listen, let's try to put something in the cloud. It's always falls through. It doesn't seem very safe and sturdy. So I want you all to really check with your tax preparer and ask, do you keep my information on the cloud? And no matter what they say, it's not secure. It's really an identity thief's dream, right? It's all names, birthdays, socials, where you work, your home address. So there are servers for these software packages that get hacked every day, and the CPAs are paid off, and no one ever hears about it. So if your tax preparer keeps your data in the cloud, please tell them to remove it, especially old years. There's no reason for your 2016 data to be on a cloud server for 3 or 4 years at all. So I say that at my office, we only use local servers. I could do your tax return without having the internet, and your accountant should do the same thing. All right, so
there was a question, not totally related to real estate, but about health costs being deductible. I don't know if you have a second to just answer that one real quick. If health costs
yeah,
are
sure.
still.
Yeah, 1 second. There I am. Can you see me?
Hi there. Hello. Yes.
Hi. Right. So if you're self-employed, your health insurance that you pay is deductible as an adjustment to income as self-employed health insurance. So that's very important. That does not go on your Schedule C as a business deduction. That's a very common mistake. Unless you are a Schedule C where you have employees and you're paying for that, you're paying for their health care. So if you have other health deductions, though, like co-pays and deductibles, that would really go on your Schedule A as an itemized deduction. So you want to separate out your self-employed health insurance and make sure that goes in as an adjustment to income on your 1040.
Excellent. Thank you. Does anybody else have any questions? You know what happens a lot in these webinars, Chris? We send, an auto follow-up email thanking everybody for joining, and a lot of times I get the 24 hours later, folks, thinking about the questions. I'm going to go on camera too. Folks thinking about the presentation and coming up with questions after that. So anything that you guys think of, you can either, take the time to pop in now. I know we went over time, but I think it was very well worth it. I think it was very informative and educational, and I really appreciate you taking the time, Chris. And like I said, if there's any other specific questions on this presentation or anything around that, either let us know now, or if there's nothing that comes to mind, we will, hopefully I'll distribute them to Chris, or you can email Chris directly, and we'll go from there. But this was hopefully the start of a good relationship in many of these, Chris. So
Sure.
I was monitoring some comments, people appreciating your insight and all the valuable information. So
Oh, great. I'm glad.
yeah, again, even though you're Red Bank, New Jersey, you are you do all the federal pieces, so feel free to reach out if you found a lot of value in this. And I know we definitely appreciate your time and your insight. So great job. Thanks so much.
Thank you, everyone, very much. I hope you found it effective.
You know what, though? Well, as I was talking about it, although a lot of these are thank you comments, Chris, I did see one more about if you are self-employed and don't have insurance, how does that work?
Well, the federal penalty would not apply anymore. So you mean in terms of penalties? Are they asking?
I'll just read it verbatim. If you are self-employed and don't have insurance, I suppose that's the question, or if there was questions around the deductibles on that. Yeah.
Well. If you don't have insurance but still have some medical, you can still take that as an itemized deduction. It's really only the insurance that's an adjustment to income. The other goes as an itemized deduction. And you have to be careful. Some states, still like New Jersey, still has a penalty if you don't have health insurance. So for federal, that might have been repealed. But you have to check with your state, whatever state you're in. There's still some that have a penalty if you're not insured.
Got it. Actually, we have a couple of hands raised. I'm going to try to now, Catherine. I see that you are raising your hand, but your mic on your computer seems to be self-muted. So I was trying to unmute you, but I was unable to do that. But we have Asha. Same thing. You're self-muted, Asha. So I'm trying to unmute you both to try to get you guys on the line, so to speak, as like a radio show. But you're both self-muted. So if you have a chance to unmute yourself, that'd be great. Otherwise, if you want to type your question into the Q&A piece, I'm unable to unmute your lines at this time. But let me just see if anything else came in. Yeah, just a lot of thank yous and all that. So this was good stuff. So again, thank you, Chris, for everything. I really I hope this was worth your time. I hope you guys get to meet a lot of new folks and turns into something good. So thanks everybody. Great insight. Go take this information out and allay all of your buyers and sellers and renters' fears. I mean, this is a great market to be getting into. So I hope this helps, and we'll talk to you guys very soon. Okay.
Thank you, everybody.
All right. Take care.